So we will start with the basic concepts initially, and then gradually get into more complex models. And two models we will discuss. One is the Black and Scholes, which is very famous, and second one is the binomial option pricing model. So let me share the screen. Okay. Is my screen visible to you?
Yes. Yes.
Okay. Okay. So this option is a kind of a derivative contract. So what is a derivative contract? So derivative contract is a financial contract is a financial instrument which derives its value from some underlying asset. Now, the underlying asset can be anything, like for example, it can be equity, it can be interest rate, it can be currency. So anything, any asset based on which the a contract is being initiated or constructed, that is called the derivative contract. Now, there can be several types of derivative contracts, but few of them are more popular. Like for example, forwards are popular, then futures are also popular contracts, then options are there, and swap is also there. So these are the popular form of derivative contracts, but it is highly customizable, and a lot of creative contracts can be constructed by using some basic principles. Now, our discussion majorly will hover around this option contract. But to initiate with, we will also discuss a little bit about these two contracts, that is what is a forward and what is a future. So what is a forward contract? The forward contract is where the date of entering into the contract and the execution of contract, there is a time gap. That means the point of time of execution of contract and the time point at which it is being executed, they are not same. They are not same. Like for example, suppose I entered into a contract to say buy ITC shares. ITC shares. So I entered into a contract today. So today is 12/09/2020. But I am going to execute it on say 12/10/2020. If I buy these ITC shares on spot market or cash market, this date will be same. So I entered into a contract to buy ITC on 12/9/2020, and I will pay and I will take the delivery of the shares today itself. So that is a spot market. But if there is a time lag, if there is a gap between the entering into a contract and the date of execution of the contract, these type of contracts are usually forwards or futures. The mechanism of forward and future is very similar, with little bit difference, but there are a lot of similarity between the forward contracts and future contracts. So Now, so there is a time gap between the two, right? So obviously, there are two parties here. One is buyer, or sometimes we call it, long. One person who has taken long position on the futures or forwards, and there is another party who is a seller or who has taken a short position on this forwards and futures. So forwards are, so this is a basic mechanism, but forwards, they are OTC contracts. So they are the two parties entering into a contract to buy or sell certain asset at a future date, and they are entering into the contract over the counter. So obviously, this is highly customizable. It's highly customizable. And on the other hand, the default risk is high. Default risk is very high because out of the two parties, the party which may get into a disadvantageous position on the date of execution, there is a high possibility that he may not turn up on the final day. He will be unwilling to execute the contract. Like for example, say if I consider our original example, suppose this is the forward contract, for example. This is the forward contract. This is the forward contract, and I am adding a rate. The rate is at the rate of 150 per share. So what is the contract? Contract is that the buyer will buy ITC shares, say 1000 ITC shares, and they are entering into a contract today. And as per contract, they are supposed to buy the buyer will buy the ITC 1000 ITC shares at the rate of 150 per share on 12th October 2020. So this is the position of the buyer, and the seller, on the other hand, he is entering into a contract today. He is supposed to sell 1000 ITC shares, which is going to be executed on 12th October 2020 at 150 per share. Now suppose on 12/10, the spot is 140. Will the buyer be interested to execute the contract? Obviously not, because his contract is to buy 150 per share, but the spot, it is available at 140, so he will try to avoid. So when he will try to avoid, because of this default risk becomes very high. In case of future, the basic mechanism is same, but it is always exchange traded. So it is exchange traded. So everything is decided by exchange, the lot size, the delivery date, everything, the basic parameters are decided by the exchange itself. So it is less customizable. Less customizable. But at the same time, the default risk is low, very low, almost nil. Why? Because all the trades which happen through the exchange, they are guaranteed. And they follow a mechanism which is called mark to market mechanism, or it's also called MTM. Because of this, the default risk is very low. So this profit and loss for on whatever side, for the buyer or the seller, that is being settled every day on day-to-day basis. In forward, the settlement happens on the expiry date. So they entered into the contract on 12th September, but the expiry date is 12th October. So all settlement, everything. So payment of the price by the buyer, delivery by the seller, everything is going to happen here on the last date, on the expiry date. But in future, they are exchange traded. So all the exchange, to ensure that there should not be any default on any part of any participant. So what they do, they settle the profits and losses on daily basis. So that mechanism is called mark to market mechanism. Because of that, the default risk is low, very low. But this is very less customizable. It is not customizable. So that is why because of this reason, the size of forward market is much bigger. Specifically in commodities and currency, this kind of markets, the forward market is much more popular than the futures. But two issues. One is that in forward market, I can decide the delivery date, and also I can decide on the quality of underlying asset, which is not possible in case of futures. In futures, I have to choose from the contracts which is available in the exchange. But in case of forward, I can directly get into a contract with the counterparty, and according I can customize on the basis of mutual interest. So this is forward and future. So we can go through a little bit of a formal definition. So forward contracts are a type of derivatives. Here one example is given. Take the example of a farmer who grows wheat. It would take around 3 months for the wheat to be ready in the farm, after which the farmer can sell it. Suppose the current price of wheat is 100 per kg, that is spot, and he would like to sell his wheat at this price, but the price would be ready only after 3 months. The farmer is unsure as to what would be the price of wheat after 3 months. Therefore, he faces price risk, and he can enter into a forward contract. And what is a forward contract? Promising to deliver the wheat after 3 months at 100 per kg. And with this, the farmer assures himself of two things: that he will get 100 per kg. He don't have to run around for getting because he is not sure what price will be, spot price will be there after 3 months. And this type of contract is called forward contract. Now coming back here, these derivatives, there are three types of players in the market. One is called hedgers. Second is speculators. And third is arbitrageurs. So all the large corporates in the market, they are actually hedgers. So this forward and future contracts can be used
Sir, your voice is not coming.
The voice is not audible.
Yeah. Am I audible now? Hello.
Yes, sir.
Yes,
Yes,
sir.
sir. Yes,
Now
sir.
you
Yes.
are audible.
Okay. Okay. So let me share this screen. Okay. Okay. So there are three kinds of players. So one is hedger. So objective of the hedger is managing risk. So if I am a producer and I want to hedge my final product, so what I will do, I will short forwards or futures. So if I am a producer, like for example, if the Tata Steel feels that the price of finished steel may come down in next 1 year, so what he can do is he can sell a forward of finished steel so that the selling price becomes fixed. So he can manage the price risk. On the other hand, if someone is for someone, if he is a managed, if he tries to manage the input cost, right, then what he will do, he will go for long on future, forward or future. So to manage input cost, price risk of input, I can change it here also. It is for price risk of output. So hedgers can use the forwards or future for managing the risk. Speculators are the people who tries to make a quick gain by anticipating the price movement. In many markets, the speculators are not allowed. The speculators are kind of, it is considered akin to gambling, and legally they are not allowed to participate. But in stock market, in derivatives market, the speculators are allowed to participate for the single most reason, important reason behind it. They provide liquidity. And liquidity, it helps in price determination. And most of the financial models, the important ones, including CAPM and everything, there one of the underlying assumption is that the market is liquid enough and the large number of buyers and sellers can interact among themselves to arrive at the correct price of the asset. So you need liquidity in the market, and that is why the speculators are allowed. And arbitrators are the people, it is a small group who make money by exploiting market inefficiency. So sometimes the market inefficiency arises, maybe because of lack of information or some technical issue or something for a very short period of time. So arbitrators, what they do, they exploit this market inefficiencies to make some little money, quick money. In arbitraging, the speed is the most important factor. Now, here also, in our example, he is managing the price risk. So you see
Sir, can
here.
you give an example of arbitrator?
Yeah. For example, if you look at the quote of BSE and NSE, you will find there is a gap. Sometimes, specifically, the companies where the liquidity is less in small cap, small cap companies, for example, those which are listed both in NSE and BSE, you will find at the same point of time two different prices are shown.
Okay.
Right. So that may happen due to availability of stocks onto in NSE. Suppose the liquidity is more, the BSE the liquidity is less. So for a very short period of time, the prices may differ, and the price difference can be significant if we consider the brokerages and taxes and other expenses, interest, etc. So there, what the arbitrators can do is they can buy at a stock exchange where the price is lower and sell at a exchange where it is traded at a higher price,
Okay,
and
sir.
make a quick gain from there. That is one way. Other way is that there can be arbitrage opportunity between spot and future also, right? So in forward, for example, in future, there is a component called cost of carrying. If the cost of carrying is not different from the risk-free interest rate, it creates a kind of arbitrage opportunity. Like, for example, if my spot price is 100 and if my risk-free rate for 1 year is 5%, then today if my spot is 100, then the future price should be 105. But if it is not 105, if it is 107 or 103, then it may create an arbitrage opportunity. An arbitrage opportunity, because of we all know that if there's efficient market hypothesis, so it says that this arbitrage opportunity cannot stay in the market for a long period of time. If any arbitrage opportunity arises in the market participants will act in such a manner so that the arbitrage opportunity goes away. So where it is cheaper, the buyers will pour in to take long position, and where it is costlier, there the sellers will pour in to sell the position. So ultimately, this process will continue till the arbitrage opportunity goes away. So this is the concept. Now, coming back to this example, suppose this farmer, he wants to protect his sell price or his input cost. So he wants to protect his sell price. So when he will try to protect his sell price, what he will do? So he is facing actually a price risk of output. He produced wheat and he is facing a risk that he may not get the right price while selling that wheat, which is going to be going to come to the market after 3 months. And he wants to avoid this risk. And for avoiding this risk, what he will do? He will go for shorting. He will go for short, right? Similarly, so he is the seller of wheat. Now, suppose there is a company which produces wheat-based, cereals, for example. Say, for example, Nestle or this kind of companies, which uses wheat as an input. And Nestle is feeling that the price of wheat may go up after 3 months because of some demand supply or something, some other, or supply chain problem or some problem. The price of wheat may go up, and for Nestle, wheat is the input. So he is also facing a price risk, but from the input side, from the cost side. So what he will do? He may go for long on the, so he can buy a forward or future on wheat, Nestle, and the seller, the farmer, can sell or short a forward or future. So if this contract they made through exchange, through any stock exchange, for example, NCDEX or MCX, the commodity exchanges, then it will be called the futures. So the futures, all the parameters, all the norms will be decided by the exchange itself. The lot size, for example, the quality specification, etc., etc. But if it is a forward, then the farmer and the Nestle, the company, they can sit across a table and they can decide that what will be the specification of the contracts, like date of delivery, like the price to be paid or received, like for example, what will be the quality specification of the wheat to be delivered, the point of delivery, in which city or which place the delivery will be made, how the payments are to be made or received. So these kind of specifications they can decide over the counter, across the table. So when it will be done across the table, it will be called forwards. But when it will happen through an exchange, then it will be the futures. Now, obviously, in the first case, if it is a forward, the default risk is high. For example, if the farmer has entered into a contract to sell at 100 rupees per kg, and after 3 months in the spot market, if the price becomes 150 rupees per kg, then the farmer will not be very interested to sell, to execute this forward. So the default risk is on the higher side. Though in forward market, the default usually does not happen much. Why? Because the players who take part in the forwards market, they are actually large players. So they won't default on their commitments because of their market reputation, brand name, etc., etc. Usually they won't do that. And the size of forward market is much, much bigger compared to the futures market. So this is the basic idea about the forwards and futures. Let's go through quickly. I will share this document. Now in futures, the difference is it is an exchange traded derivative, which is similar to a forward, which we already discussed. It is very similar, but exchanged through a traded through an exchange. Now coming to our main point, that is the option. Now option, now see, in case of forwards and futures, when the parties entered into a contract, the buyer has an obligation to meet the terms. He cannot come out of the contract. If the contract goes against his interest, he cannot come out. Like for example, if I entered into a future contract to buy ITC shares at say 150, right, on 12th October, in this case, if on the spot, on 12th October, on the spot, if the price is 130, then I cannot come out. I cannot say, no, it is available at 130. Now I entered into a contract 1 month back to buy it at 150. Now I don't want to buy. I can't say that. The only thing I can do is I can sell it to someone else who is willing to take over the contract for me. And in that case also, I need to incur some losses, right? But in case of option, if the terms of the contract says that buyer has no obligation to execute, then that type of contract will be termed as an option contract. So buyer, if he wishes, he can execute, but he has no obligation. So in option, there are two parties like other contracts. One is buyer, or I can say who has taken a long position, and seller, I can say who has taken a short position. Okay. So the buyer is having the right but no obligation. But for a seller, has to oblige the buyer. So taking this example, suppose if I consider this original example, if this is my example, then the two parties, buyer and seller of option, they entered into a contract to buy 1000 ITC shares on 12 September 2020, whose expiry date, this is my expiry date, at 150 per share. This I will call is my strike price. This I will call my strike price, right? So this buyer and seller, they entered, suppose if I name them as X and Y. So X is the buyer of option and Y is the seller of option. So they entered into a contract. The contract is to buy 1000 ITC shares on 12th October 2020, which is the expiry date of the contract, at the rate of rupees 150 per share, which is a strike price, right? Now, there can be two situations that on 12/10, the spot is more than 150. This is situation one. And second situation is the spot is less than 150. So in this situation, these are the two scenarios possible. Now in this scenario, in the first scenario, if the spot is less than 150, then the buyer of option, right? So suppose I am saying it is a call option. It is a call, right? Call is, that is, they are entered, the call buyer has entered into a into buying ITC shares at a future date at a predetermined price. Then if it is spot is, then the call buyer, is it beneficial for the call buyer to execute? If the spot is 150, then obviously it is beneficial for the call buyer because he entered into the contract to buy at 150, and on the
Yes, yes, it
expiry
is.
date, so call buyer, what he will do, he will
Yes, it is.
execute, right? If we execute, then seller has no option but to oblige. Seller has to,
So, but if the spot is more than 150, buyer will not execute. But I believe.
no, buyer will execute because contract is what?
Okay.
Contract is I will buy at 150.
Yes, yes, yes.
Now it is 160, then he will execute, buy it at 150, sell at
Yes,
spot at 160, 10 rupees profit he will make, right?
yes, yes, yes.
But if it is less than 150, then for this call buyer, it is not very beneficial because in the spot, if it is available at 130 and if his contract is to buy it at 150, why he should go for buying at 150 when it is available at 130 at spot? So call buyer will not execute. So he will allow the option to expire. He will simply allow the option to expire. So when he will allow this option to expire, then now the question is, this right, that is the right but no obligation, this will he get it free? Obviously not.
No. He has to
He
pay a
has to
premium.
he has to pay some price for it, because seller is allowing this right to the buyer. So seller will not allow this right to the buyer free of cost. So the buyer, for getting this, getting that right, the buyer needs to pay premium. And who will collect this premium?
The seller.
The seller. So in this case, the call buyer, in this case, this call buyer is in profit. So he will execute, earn the profit. But in second case, the call buyer will not execute, and the seller will keep the premium. Seller will keep the premium.
The premium is nothing but the price difference, no?
Say premium is the price the buyer is paying to the seller for getting the right. For forward and future, there is no question of premium. No premium. Here, the only thing the buyer and seller both need to pay is the margin. Buyer or seller need to pay margin. But in case of option, the buyer need to pay the premium. This premium, how can I arrive that how much premium one can the buyer need to pay? So there must be some calculation, right? So the premium can be computed by use of models. So this is the valuation of option models which you will study. That is the Black and Scholes and the binomial. Okay. So these are actually the option valuation models. But where the options are traded in large number, the prices are often determined by the market forces. Now, before moving to the next part, yes, do you have any question?
My question
If
is
there is,
that
sorry,
Yeah.
is that compensation or the premium is to be determined between that price already fixed plus that current market price available, is the difference will not be the compensation should be made available to the seller?
Okay, your question is that how this premium is to be
determined, yeah.
determined. We will come back to it. When we will discuss the Black and Scholes, we will discuss this in detail. Now, a few basic concepts. One is that options can be classified primarily into two types. One is called call option and second one is called put option. So call is actually right to buy. Right to buy, and there are, what are the parameters? First parameter is expiry date. Second parameter is strike. Like in our example, the expiry date was 12th October and strike was 150. So this example which we discussed, this is actually example of a call option. So here the buyer of the call, he is entering into a contract to buy the underlying asset. The underlying asset is, here it is ITC share. So third parameter is underlying. Third parameter is underlying. So there are two parties. There are two parties. One is called buyer, and second party is called seller. These two parties are interacting among themselves to buy a right to buy, not to buy the underlying asset. They are buying a right to buy and selling a right to buy of the underlying asset at a given strike price, which is going to expire on a predefined date. So here in this example, the call buyer and call seller is entering into to buy ITC shares, which is the underlying asset, with a strike price of 150 rupees per share, which is going to be expire on 12th of October 2020. So this is the basic idea of the call option. The put, on the other hand, it is right to sell. Right to sell. So there are two parties. One is put buyer and other one is put seller. The other parameters are same. That is, there is a expiry date, and there is a strike, there is a underlying. So other parameters are same. So in case of put, the put buyer is entering into a contract with the put seller to sell the underlying asset at a given strike price by a certain expiry date, right? So this call buying, it is a bullish strategy or bearish strategy?
Bullish.
It is a bullish strategy. And call selling is bearish strategy. And just opposite, the put buying is a
Bearish.
bearish strategy. And put selling, sometimes they ask these MCQs on these concepts. So it is a bullish strategy. So this is the first classification. The second type of classification is one, in the money option. It is also called ITM. Out of okay. ATM. Before discussing this, and there is one other classification which is called European options. and 2 options. Now, before going further, let's look at this one thing which is called the option chain. This is called option chain. Fine. Now, this is the option chain for Nifty. This is the option chain for Nifty. This is the expiry. Today's date is, it expires, is a weekly contract. For Nifty, it can be weekly as well as monthly. The weekly contracts expire on every Thursday. So 17th, one series will expire, then 24th, one series will expire. In 24th, the monthly series will also expire. Then 1st October, 8th October, it will go on like this. So now, the left hand side, it is showing the details about the calls, and the right hand side, it is showing the details about the puts, right? Now, this middle one, this one, this row is showing the strike. Now you see, showing 464. Yeah. Now see, this is the spot price of Nifty. Today is Saturday, the market is closed. This is the closing price of Nifty, 11,464. Now, let's consider this one, 11,300 strike. For the time being, let's ignore this premium. Its premium is around 200 rupees for 11,300 call. Now let's, for the time being, ignore this premium. Let's assume that the premium is 0 and the brokerage and other taxes are also 0. Then a call buyer, if he takes a position on this strike, 11,300, then what is the contract he is entering into? I am going to buy Nifty at the rate of 11,300 by the expiry date of 17 September 2020. This is the contract. And the seller is saying what? Seller is saying, I am going to sell Nifty at 11,300 at the rate of 11,300, and which is the expiry date? Expiry date is 17 September. Now the spot is 11,464. So if he enters into the contract, and if I assume that he can immediately execute it, then he can buy a call at 11,300 strike, immediately execute it in the spot, and can make a profit of 164. 11,464 minus 11,300. So 164 rupees he can clearly make per unit of Nifty. So this type of option where the buyer can make immediate profit ignoring the premium, this type of option is called the in the money option. Practically, it is not possible. Why practically it is not possible? Because if it happens, then it will create a kind of arbitrage opportunity in the market. And because of the efficient market hypothesis, the market players will react in such a manner that the arbitrage opportunity will go in a short period of time. Sometimes it happens when the liquidity is very less, when the volume is very less, that type of contracts, but it doesn't, exist for a long time. So this call option of 11,300 Nifty, this is actually an in the money option, in the money call option. So you can see in this option chain, all the in the money call options are little grayish. And this out of the money, this is not possible in case of 11,600 strike, because the spot is now getting sold at 11,464. So if I enter into a call, if I buy a call and enter into a contract to buy Nifty at 11,600, then I cannot make immediate profit by executing that contract. So all these white part of call, these are actually out of the money calls. And all this gray portion of the call option chain, from this upward, they are actually in the money call options. And where, so I can write here for a call. So I can write here uh, for a call, if my strike is less than spot, then it will be what? It will be in the money. Similarly, for a call, if the strike is more than spot, then I can say it is out of the money. Like for example, here, the strike is higher than spot. 11,500 is higher than 11,464. So this option, call option, is OTM, out of the money. And for a call, if strike is equal to the spot, it is, I can say, it is at the money. Is this fine? So sometimes MCQs, they ask on the basis of these concepts, the ITM, OTM, and ATM. For a put, what will happen? For a put, it will be just reverse. So for a put, it will be just reversed. So for a put, if strike is higher than spot, then it is ITM. Lesser than spot, then it is OTM. Otherwise, it is ATM. We can have a view of this option chain. The strike 11,550, it is higher than spot. So you see, it is in the money. It is gray. 11,300, it is less than the spot. This is out of the money. This whiter portion. It is just the reverse. Right? So it is this is the concept of ITM, OTM, and ATM. European options, the other classification, European option can only be exercised on expiry. The American options can be exercised before expiry also. This can be exercised before expiry also. This European is more popular. All these Nifty options and Bank Nifty and all, even the stock options, they are actually basically European in nature. The reason is that in American options, the buyer can exercise his right even before the expiry date. That creates a lot of uncertainty for the seller because the seller doesn't know that when the demand will come from the buyer. So it creates a lot of volatility in the market. Because of that, the European options are more popular because in that case, the expiry will happen only on the expiry date. So before that, the seller also remains prepared to obligate his duties, his liabilities. Now, out of this option chain, this is last traded price. This LTP is nothing but the premium. The LTP, which is shown here, the LTP is actually the premium. It is the last traded price. Now, this premium can be determined, number one, by market. This premium which we are observing here, this premium which we are observing here, this is determined by the market forces, by the buyers and sellers, right? But this premium can also be determined by models. So where the options are not listed in the market, for example, the OTC options, right? So in such a case, the models are used for computing the value of the option, the premium of the option. So one is, there are many models, popular binomial, and Black-Scholes model. These two models. Okay. Now, the first column of this option chain, it is called Y, open interest. Okay, before going there, let's see if anything we have left. So we discussed the calls and puts. American option, European option we discussed. Okay, all options are European in NSE and they're more popular. The meaning of strike price we have already discussed, the price at which they agreed, the two parties agreed to get into this contract. In the money, out of the money option we discussed, at the money we discussed. Some illustration is also given here. Expiration day we discussed, like for example in this example, the 17th September, this is the expiration date. This we discussed. And open interest. Right? So this first column, this Y is open interest. Open interest is the total number of contracts which is open. This is the open interest at the time of closing of the market yesterday on Friday. So the formal definition is is the number of contracts in futures and options which have been entered into by investors and which have not been closed out or expired. It gives an indication of the depth of the market. So from option chain, we can see that in call, the highest open interest is at 11,500. You can see 11,500 is the highest option chain, where that means most of the people have taken position at in call at 11,500 and they have not closed it. It is still open. The contracts are open. In case of put, the first large open interest, these two are almost same. The first one is at 11,400 and the second one is at 11,300 and the next one is 11,200. Right? So open interest, the rise in open interest shows that the market participants are increasing their participation in the market. Right? Now this LTP, this premium, in this case, these are highly traded. You can see the open interest here, 24.4 lakh here. That means 24.4 lakh contracts are open. Call contracts are open at 11,500. Now here, this premium is now this premium which I am getting from this this column. It is actually this price is being arrived by the interaction of the buyer and seller. It is the demand and supply. Now, this premium has two components. The premium is equal to intrinsic value plus time value. Now, intrinsic value is difference between strike and spot. Difference between strike and spot. So if I consider, let's see, suppose say 11,300 strike. 11,300 strike, the premium is 200.1. So 11,300 call strike, premium is 200.10 and my spot is 11,464. So this call, it is ITM or OTM? This call is an ITM call, in the money call. So my intrinsic value is
164.
Value is the difference between spot and strike. So 11,464 minus 11,300, it is 164. And but what is the premium? 200. So this difference is what? Time value. Time value is how much? 200.1 minus 164. So it is coming to 164, that is 26, 36, 36.1. So 36.1 is my time value. And this 164 is my intrinsic value.
Mr. Banerjee,
Yes.
could you please explain this calculation? I could not exactly follow it.
See, if I look at this option chain, it is giving the details of all the options which is available and traded on Nifty in the National Stock Exchange. Right? This is real data, real time data. It is, I have taken it from Sensible. Okay. Now, here, so this is the strike. Fine. Now you see, this is in the money call.
This is the strike for particular script, or this what are these?
It's for Nifty.
This strike is for Nifty options.
Nifty options for particular script, or it is a for total?
No, for the index. For the index.
For the purpose of indexation. Okay.
Yes. This is for the index, and the spot of Nifty is this 11,464, and this is a contract, say call contract. Okay. Now, suppose if I am the buyer and if I wish to buy this call, whose strike is 11,300 and which is going to expire on 17 September, I will need to pay this 200.1. This one, you can see that if I move it
That is
here.
the difference.
Now this 200.1, this is the premium.
Okay.
Now this premium is the composite of two factors. One is intrinsic value and the other one is the time value.
Okay.
Right? Now this intrinsic value is the difference between spot and strike. So that's what we did here.
Difference
So-
between spot and strike.
Strike.
Spot is 11,464.
Yes. Yes.
And the strike is some 11,300.
Yes.
Okay, so the difference is coming
164.
Okay.
But my premium is how much? 200.
That how this is calculated premium?
This premium I am getting from here, from this
directly
option
from
chain,
the
but it is defined by market.
Market. Okay. We need not bother about the calculation how this is arriving at this
No,
figure.
no, not now. Not now at least.
Okay.
Okay.
Understood.
Now it is an interaction of the buyer and seller, and it is yesterday's close is 200.1.
Okay.
So now this difference, this 200.1 and 164, this is actually the time value.
Okay.
Okay. Now for ITM, there is an intrinsic value, but for OTM options, intrinsic value is 0. So intrinsic value we can get only in case of ITM options. We have taken an example of an ITM call here. This is an ITM call because the strike is lower than the spot. But if I consider, for example, this option 11,600, the premium we can see here is very less, 34.85. That does not mean that it is cheap. It is not cheap. It is being traded at a lower price because it has no intrinsic value. For the same strike, we can see for a put, the premium is quite high. It is 177. But for call, because this put is in the money put, right? But the call is out of the money. So for OTM options, the intrinsic value is 0. Only time value is there. Now time value, it reduces as the time to expiry comes nearer. Okay. Now, so this is OI, this is LTP. Now there is a very important parameter here. It is called IV. It looks like Roman 4, but it is not 4, it is IV. It is implied volatility. This is implied volatility. Now, we will discuss implied volatility from the perspective of Black and Scholes model. Now, Black and Scholes, this is I think one of the most popular, well-known, one of the most well-known after CAPM, most well-known model in finance. Now, Black and Scholes model, the Black and Scholes, they said that we can calculate the value of an option if we know 5 parameters. So this is the formula for calculating the value of a call as per the Black and Scholes, and this is the formula for calculating the value of a put as per the Black and Scholes, right? So this is a complicated looking formula, but if we look into it carefully, we will find that there are 5 variables on the right hand side. So Black and Scholes said that the value of, according to BSM, the value of an option depends on which factors? Number 1, spot price of underlying. 2, the rate of interest. 3, time to expiry. 4, volatility of underlying. And number 5, strike. So if I look at this formula, for example, if I look at this formula, C is the value of call, S naught is the spot price of underlying, then N is the normal function, it is a statistical function, normal. D1, within the D1, how D1 can be calculated? D1 can be calculated by using this formula. S naught is the spot, K is the strike, K is here also. Then R is the rate of interest. Here is also R is there. Then sigma square, sigma is the volatility. And then T, the time to expire. That means, as per the Black and Scholes, if we know the values of these 5 variables, if we know the value of these 5 variables, then we can calculate the value of an option. So in both the formula, we are considering, for understanding, we are first trying to understand the formula for valuing a call option. So if I know the value of S naught, the spot, the R, risk-free rate, T, the time to expiry, and sigma, the volatility, and the strike price of the contract, then I can, if I put this on the right hand side, straight away I will, on the left hand side, I will get the answer, the value of the call. Fine. Now, so there's a lot of mathematics behind it, right? But the point is this, that I only need these 5 values of these 5 variables. I have to put it in the formula immediately in the Excel. If I put, immediately it will give me the result, that what is the model value. What is the model value of the call option, right? The market value and the model value may differ. It always differs. Most of the time it differs, right? Now, in this formula, if I look into these 5 variables, I can see this spot price is given. I can take it from the market. This is given. The risk-free rate of interest, I can get from the RBI. In India, I can get it from RBI. What is the risk-free rate? Time to expiry, I can choose. For example, these options, I have chosen this 17 September. I can also choose, if I wish, 24 September. The chain will change. So I can do that. So it is up to me that which expiry I want to choose. Strike, I can choose. There are a lot of options. I can choose the strike 11,300, 200, 400, whatever. I can choose. So the only complicated thing which is important for me, very important for me, and which is not controlled by me, right? That is the volatility. This volatility I cannot control. Strike I can choose, time to expiry I can choose, rate of interest is given, spot price is given. But this volatility, sometimes the volatility will go up, sometimes the volatility will come down, right? And usually the volatility moves in a cluster. Okay. So this is actually a major contribution by the Black and Scholes, right? They introduced this concept of volatility while calculating the value of option. Now, if I look at this formula, and if this call price I take from market, for example, suppose I am considering this option 11,300 strike call, right? So if I consider this, then my spot price is how much? I can take it from here 11,464. I can take it from the market. Rate of interest, I can search also. Say, for example, if I search risk-free rate in India, 2020. So I can take, for example, here 6.47%. So I am taking it here 6.47%. 6.47%. Time to expiry, I can choose 17/009/2020. Strike, I have already chosen 11,300, right? Volatility, I don't know. And what is the output? Output is value of call. So call value, the market value, this I know from the market. This is 200.1, right? And if I put all these values into that BSM and then calculate this sigma, then the sigma which I will get, this is what? This is actually the market's perception about the future volatility. That is why it is saying implied, not historical. It is implied volatility, not historical volatility. So when I am saying the implied volatility is 16.2, right? So I am actually, what I am doing in this formula, I am putting the value of market value of call, I am putting the market value of spot, I am putting the value of strike chosen, I am putting the value of R, putting the value of T, and then I am calculating the value of this sigma. The value of sigma which I am getting, that is actually the implied volatility. So this implied volatility has some predictive power. So it is actually showing that if the implied volatility is rising, that means the market participants are feeling that the volatility in near future is going to go up, right? Otherwise, they may be feeling that maybe it is going to come down, right? Now, implied volatility, you see, for every strike there is an implied volatility, so it is difficult, sometimes, though this is used by the traders, this implied volatility figures. But one measure which is very popular, becoming very popular nowadays, it is called India VIX. In every newspaper you will find it. This India VIX or volatility index, this is actually calculated on the basis of option prices only, right? So this is a 1-point measure in option chain. In option chain, for every strike there is an implied volatility. So I can one way is to track create a chart of this changing implied volatility when the market will be running. The other thing is, if I want to get a view that what would be the future volatility, right? I can look at the VIX also. The VIX actually shows that what is the expected volatility of the market participants in the coming 30 days. This volatility is 20.71. This figure is not showing that what is the volatility at that point of time. It is actually showing that in the forthcoming 30 days, how much volatility the market participants are perceiving. And if you look at this graph, you will see that most of the time they move into a range. It is not a cumulative index, right? So sometimes the market becomes jittery, people become greedy, fearful. So at that time, the VIX goes up. When they are come down, gradually relaxed, the VIX comes down. So it is a major, it is also called the fear and greed index, fear index. You can see during the COVID, it was at a peak, very abnormal for the entire lifetime of India VIX. If I look here, it started in 2010, right? Only once it was up here, 14 at time of Lok Sabha election. Went up, then came down, then you see it is within a range itself. This is the time when the first news of, I think this is the second election, second time BJP government when got elected. Again, it was up, but it reached the peak, historical peak at the time of COVID. And then gradually it is coming down, right? Now the vaccines failed initially, otherwise it would have come down again. Otherwise, that's why it is still above just 20. Its historical rate is around, you see, it is around 16 or some 12, 13, 11 is very low, around 16. Between 10 to 16, this is a normal range. So, coming back,
Can we use this number as input to the Black-Scholes model and calculate the premium for any given strike and time to expiry?
you can do, yes, we can do. We will do that. Yeah. So this is the Black-Scholes. We're coming back to that. This is the Black-Scholes model, so we can put the values here. Now, before going to one thing I want to discuss, so you can see the Greeks. So it is based, as per the Black-Scholes model, the price of an option is based dependent upon these 5 parameters. So these 5 parameters, if any of them change, obviously the option value will change. So this concept is called delta. Greeks. Greeks. So what are the Greeks? Number 1, delta. Delta. Number 2, gamma. Number 3, beta. Beta. Number 4, theta. And number 5 is rho. So delta is change in price of option due to change in underlying stock price. So change in underlying stock price, this is not. If I look at this, formula, S naught. If S naught changes, the C will change. So delta is the change in,
By keeping everything else constant?
yeah, keeping everything else constant. Change in option price with change in price. Gamma is rate of change in delta. So if delta is the speed, gamma is the acceleration. Beta is with change in volatility. Theta is time, and rho is interest. Fine. So if I go back to this rho is usually not very important specifically for short time period options, because interest rate usually changes very slowly. So if I taking a position on in a weekly option or even a monthly option, it is very unlikely that the interest rate will change very drastically. Even if it changes, the change is very small, and it is already the market participants, they try to preempt that what changes are possible. So rho is relatively unimportant for short-term options, but the other 4 is important. So in the option, this option chain also we can see they have considered for these 4. So one is delta, call delta, put delta, then theta, then vega and gamma, right? One important thing to see here, notice here, is that this theta is always negative, because the value of an option always decreases as it comes nearer to the time to expiry. So theta cannot be positive for an option. So theta is always negative, right? Now delta is very important. So you can see the more in the money you will go, the delta is higher. So as a market participant, my objective is to always expire in the money. Now this possibility of expiring in the money, that increases when? That increases when I am already in the money. So we can see from here also that for a call, you see the ITM probability is 52%. But if you go here, it has become 60. If you go more in the money, it is 68%. So for a call, the more you will go in the money, your the probability that you will end in the money on the expiry date by on 17 September, that probability increases, because on 17 September 3:30 p.m. when this option will expire, all the out of the money options, the value will be 0, because it has all OTM options have only time value, so no intrinsic value, so the entire time value will get expired when it on 17 September 3:30 p.m. So only the option player who has taken a say long position in call, he will be able to make the money if his option ends expires in the money on 17 September 3:30 p.m. Fine. So so the more out of the money call you are going, you see the delta is less, right? The delta is less. So this is also one of the reason why these options pricing are so less. Here it is 22 rupees, then 13.9, then 8.5, then 5, then 3.90. So it is because it is less means that it is not, doesn't mean that it is cheap. It means that it is cheap. It is price is less because its value is like that. Its value is less, right? Because the possibility that say 11,800 call will expire on 17 September in the money, that possibility, that probability is very, very less. So that is the reason why, and also it will not move. When the underlying will move, then this call premium will not move in tandem. Why? Because its delta is less. And also you can see, the more you will come, you see here and near at the money, the gamma is more. Gamma is the acceleration. So delta is high, gamma is more. So when the underlying price will move, as per if you are a call buyer and if you are bullish, then whenever it will move up, these options will move faster compared to these deep out of the money options or in the money options. This one, it is called Vega. Here it is written here, change in option price when IV increases 1% and nothing else changes. So Vega is the change in option price due to change in volatility. So for volatility, so if 1%, this implied volatility here, if it goes by 16.2 to 17.2, this option price will go up by 5.85%. So the higher the Vega, the with change in volatility, the movement in the option price will be more. And we can see here that the more out of the money we go, the Vega is less. That is why this sometimes the novice market participant, those who are new, right? Sometimes they take position in deep out of the money options, right? So without, because they look cheaper, 3.90 rupees, 2.90 rupees, so they look cheaper, right? But making profit by taking into position into this kind of option contracts, it is very rare. So these are the option Greeks. Option Greeks, many times the question comes on option Greeks. So basic MCQs, that what is delta, they will give 4 options and one option you need to tick in. So
basically, Mr. Banerjee, these are the sensitivity analysis kind of thing, no?
It is a sensitivity. Yes, it is a kind of sensitivity. Yes, that is. So if we consider that the Black and Scholes works, then this Greeks can give us an idea that how the option price will change with change in sensitivity, change in the this underlying variables, underlying variables. So this is Black and Scholes. I want to show, I think, this one, the calculation part. So now it is with advent of Excel, it becomes very easy. So let's see, this is a template. So stock price now, the spot. So we have seen it 1-1, I think 464.
6-4.
464.
Yeah,
So
1-1-4-6-4.
464, yes.
4-6.
11464. Excel size we consider 11300, for example.
Yeah.
300. Number of periods, it is fine. I can make it. Today is Saturday, so Monday is a weekly expiry. Monday, Tuesday, Wednesday, Thursday. So 4 days. So I'm making it 252 actually. 52. Risk-free rate we have seen 6.47 at that time, 47%. So standard deviation, suppose if I take the implied volatility here, let's see, 11,300, 17.6 is the implied volatility. So I am putting the same value, let's see, 6%. You can see this is the value of the call. The model value is coming 211. It is not very far away. Here the market value is 200 and the value of call is 41. So the formula is giving me 36. So slight difference maybe because of, I don't know that which form, what risk-free rate they considered while calculating this IV. So
This calculation is for the sigma. The 36 is the sigma, that is volatility.
No, this is the model value of the premium. The market value of the premium here it is showing 200.1. This is the market value to call, but the model value, our model is given 211. So that is what we got.
If everyone uses this formula, everyone would like to look at that particular price, and there won't be any trade, right?
Actually, what happens that this price is determined by the interaction of the buyers and sellers. This is a demand and supply in the market. Now, till now, the Black and Scholes is the most acceptable model, but something is still unknown. There are many other models also. So we
Actually, sir,
yeah.
yeah, we have to be, in an exam point of view, we have to be calculate it's manually or what? There is no
No, in
option
the
is
exam,
available like the formula.
in the exam, they
Yeah.
will provide you the MCQs. So,
We have to find out now what is the kind of premium, what is the call
no,
put
that values will
price.
be provided. Those values will be provided in the if the question. I will share some questions, the model questions like this.
So
I think
This
his
not this.
concern is, Mr. Banerjee, since the
Yes.
but we have
calculation
to solve
involves
now.
very tedious,
Huh.
and big calculation.
No, not
So
TDS
we
and
are,
big calculations are not given usually. They
okay.
give like this type of questions. These are simple
Yeah.
theoretical questions that when
Now,
stock
if
price
we have to
increases,
find out, if we have to work
conceptual.
out the value of sigma or the value of that C,
No,
so
no,
then all
no,
this formula,
no.
we
Those
need not
type
keep
of questions.
this
No, no, no,
formula in mind.
no, no.
Okay.
Those type of questions they won't provide. Where you need Excel or something. Not that.
Correct. Heard
Like for
point
example, this type of questions. Basic questions.
Okay.
Basic conceptual questions
So what
usually they
about
ask.
for valuation? We have to be go through this.
Yes, yes.
But
Like for
minimum
example,
valuation
this
proportional, we have
one.
to.
Huh. Like this
penalty.
type of questions, this number of trading days usually assumed for equities. This type basic understanding, conceptual, not very long mathematical question, not like that.
Oh,
Okay. So this question bank I will share. The team will share with you. I think that you will find that useful.
great.
So this is about the Black and Scholes. Now in Black and Scholes, there is a nickname of Black and Scholes. People call it a black box model. Why black box? Because here when you are putting the variables into the model, it is not showing you that what is happening behind. Behind the scene, there are a lot of mathematics and all these things, but it does not show you. It gives you the final result. Right? So what is cooking up behind the scene, that is often not understandable by the user. He gets a final value like we got in this Excel. For decision making purpose, that is why there is another model which are still popular, though it is not very sophisticated. It is not sophisticated, but it is very useful for decision making purposes. That is called the binomial model. This model, the binomial model. Now in binomial model, the assumptions are simple, but it gives the value of an option at every node. So let's consider this model. This is a basic model. Suppose the stock price, the current stock price is $20, right? And it may go up or come down. I am assuming that in next 3 months, it can either go up 10% or come down 10%, right? It can become 22 or it can become 18. Okay. So my objective is what? My objective is to value a 3-month call option on the stock, and the strike is given as 21. Okay. So if the strike is 21 and if it is a call option, then what will be this option will be in the money, and what will be the price? 22 minus 21, that is 1 after 3 months. And this, if it comes down, if the stock price comes down, it will be out of the money.
Yeah.
It will be out of the money, and for out of the money, I know that the buyer will allow it to expire, so its value will be 0. My question is, what is the option price here? This option price I want to calculate, and my assumption is in the next 3 months it can either go up by 10% or come down by 10%. Very simple assumption. Now, so what I am doing, I am creating a replicating portfolio. I am creating a replicating portfolio, and this portfolio contains long delta shares and a short 1 call option value. Right? So if that happens, then the value of portfolio will be on the upside, it will be 22 into delta minus 1, because the stock price is here 22 and 1 is the value of option price, so it is 22 delta minus 1, and this will be 18 delta. Now if I equate these two, the portfolio will become riskless when 22 delta minus 1 will be equal to 18 delta. And if I solve it for delta, if I solve this equation, the value of delta will be 0.25.
So this delta is nothing but the change in price, no?
No, it is not change in price. It is a part of the share which the investor is holding in the portfolio. In
Okay,
practice,
that is
in
basically number of shares.
number of shares, yes, it is number of shares. But here the assumption is that the investor can also hold a part of share,
Okay.
right? And in this, the part is here, in this example, the part is 0.25. So my option is what? My portfolio becomes what? My portfolio is long 0.25 shares and short one call option. And my risk-free rate is this 12%. So my value of
So
portfolio,
where we are going to apply this?
huh? So I am
Sorry,
going to
where
applying
we are
it.
going to apply this 12%?
We are going to apply
This
it
risk
for,
rate is
yeah, I'm coming to that. Yes, 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 yes. I'm coming. Now, in this scenario, if it goes to 22, if the stock price goes to 22, then the value of portfolio will be 22 into 0.25 minus 1, that is 4.50. So value of portfolio will be 4.50 here at this point. After 3 months, this arrow is representing a 3-month period.
Yeah.
So the value of portfolio here, it will be how much? The present value of the portfolio here. So I am calculating the value of present value 4.5 into e to the power minus r. So e to the power minus r is 12%, it is given, and t is 3 months. So 3 months is 3 by 12, 0.25. So the value of portfolio here is, it is 4.36 at this point. So first I calculated the value of portfolio here, then again I am calculating it back, calculating the present value here, which I am getting 4.36. Now please listen to the argument. The argument is,
Sir, what is
yeah,
this E?
E is
In next
exponential.
slide.
Now see
How we
when,
calculate this in number?
yeah, I'm coming to that. See, if I say when I am doing compounding, suppose I am doing compounding. Now compounding can be, one can be discrete. So when it is discrete, the formula is future value is equal to present value into 1 plus r to the power t for discrete. And if it is continuous, in case of continuous compound, fv is equal to pv present value into e to the power rate of interest into t. Uh, and for discounting, if here we did the discounting, so discounting 1, if it is discrete, then my present value will be just this thing. So is equal to fv uh, fv 1 plus r to the power minus t. And for continuous, discounting, for example, So PV is equal to FV, future value, into e to the power minus RT. So this is the formula. So in this case, continuous compounding is where is discrete? Discrete is where the compounding, there is a thumb rule, the compounding period is greater than 7 days. And continuous is where the is less than 7 days. So in stock market, usually the price changes continuously. So if I keep money in post office, there the compounding period may be per month or per quarter. So there we apply the first formula, the discrete one. And in case of stock market, where the price is changing continuously, then we use this continuous compounding formula. This E is actually exponential. So the exponential value we can see from here. Here is a function. XP 2.414. Let me check. Wait. Value. $2.718. This is the value of exponential. So exponential value is
This is a universal value.
This is a constant.
Constant.
2.718. Like pi is a constant, exponential is also a constant. Okay. So here, so what we did here, we calculated the present. Now the logic is that if we assume that here is no option in this portfolio, there is no option, then what should be the value of this portfolio? 20 into 0.25, because delta is 0.25. So 20 into 0.25, it becomes 5. But the value of portfolio we are calculating is 4.367. So why this difference is happening? Obviously, this difference is coming into place because the existence of option in the portfolio. Because of the existence of option in the portfolio, this is the value of the portfolio is not 5 but 4.367. So the difference between the two, the balancing figure, it is nothing but the value of the option. So the differencing figure, the balancing figure is 0.633. So this 0.633 is the value of the option. Fine. Now we can generalize it. We can now if I add say probability here. Say I am saying this is my spot. This can go up to S naught U up, S naught D down, and if U is the option value here, if D is the option value, if it goes down, my objective is to calculate the F, where P is the probability for upside, and obviously 1 minus P is the probability of downside. Now let's take this the original example, the older example. Here, this is 20, like the earlier example, this is 20. It may go up to 22, my assumption. It may come down to 18. If it goes up to 22, the option value will be 1. Otherwise, here it will be 0. My objective is to calculate F, right? And P is the probability here, and it is 1 minus P is the probability on the downside. So I can equate it 20 into e to the power RT, 20 into e to the power RT is equal to 22P plus 18 into 1 minus P. So the value of P is 0.6523. So if this is 0.6523, this will be 1 minus 0.6523. Okay. And now my final tree is like this. So 20, if there is an upside, it become 22. If the downside, it will become 18. 0.6523 is the P. 1 minus P, 0.3477, 1 minus P. I have to calculate F. So I can calculate by F by calculating the present value of these two options. So my value of option is e to the power minus R, 12% R, it is given already earlier, into T. T is 3 months, so 3 by 12. So 0.6523 into 1 plus 0.3477 into 0. 0 is the option value here. So I am getting the same result, 0.633. Now, one of the beauty of this method is we can see that this method is dependent on so many assumptions which may be unrealistic. We assume that it is 10% up and 10% down. What will happen if it is 15%, 15%, or minus 5%? So, but the point is that at every step, it shows me the result. So if I can extend it, this is for 3 months, I can extend it for another 3 months, then another 3 months. So it can continue like this. So let's look at one problem on option valuation using binomial trees. Yeah. So this is a problem. The current price of non-dividend paying stock is $30. Use a 2-step tree. Here it is 2-step. 1 step and then 2-step. 2-step tree to value a European call option on the stock with a strike price of $32 that expires in 6 months. Each step is 3 months and risk-free rate is 8% with continuous compounding. What is the option price when U is equal to 1.1 and D is equal to 0.9? Then that means it is 10% up, 10% down. That is my basic assumption. So the first is, this is 30. I am starting from here. 10% up, 33. 10% down, 27. This is after 3 months. Then I want to extend it again. 33, 10% up, 36.3. 10% down, 29.7. 27, 10% up, 29.7. 27, 10% down, 24.3. Fine. So I am moving from left to right first. First, I am moving from left to right. Then I am coming to the last stage. This is the last stage. What is my strike? My strike is 32. And what is the option? Call option. So if it is strike is 32, and in case of a call option, this one is out of the money because my spot is lower than strike. So this option is out of the money. So I am getting it 0. Right? Because I have a right to buy at 32 and its value is now 24. So will I exercise? I will not exercise. I will allow it to expire. So its value is 0. 29.7. If the after 6 months, if the spot becomes 29.7 and if my strike is 32, as a buyer, will I exercise? I will not exercise. I will allow the contract to expire. So the value of option is 0. But if the price of the asset becomes 36.3 after 6 months, and if my strike is 32, then I am in the money. So I will exercise. Why? Because I will exercise. I will buy at 32 by exercising my option and sell it in spot at 36.3, and in this process I will make a profit of 4.3. So my value is here 4.3. So I got 3 option data points here. One is 4.300.
Why, sir, you put 00? Why you don't put minus?
No, it cannot go beyond 0 because my is that if it expires, I will not do it. I am not gaining anything out of it. So it is either greater than 0 or 0. It cannot go below 0.
No, strike by 32, eh?
I am allowing it to expire. I am not doing anything. So if I look at this, say this option chain, on the date of expiry, all these calls which will expire out of the money, here the LTP will be 0. Right? You can check it out. On 17 September, if you open at 3:25 p.m. this option chain, then all the out of the money options you will find that it is 0. Only the in the money options, here the intrinsic value will remain in the LTP. The others will become 0. So now I got the last line entirely. Now I am again coming back. First I am moving from left to right, then again back calculating from right to left. So I calculated P. I can calculate P by using this method. They did it by using this formula, or we can do it by like this also. The result will be same. Okay. So the value of P which we got is 0.6010. So 4.3 into 0.6010 plus 0 into 1 minus 0.6010. If I calculate this, I will get this value 2.533. I repeat again, 4.3 into 0.6010 plus 0 into 1 minus 0.6010. If I calculate this, I will get this value 2.533. And here it will be 0 because both these option values are 0. So obviously it will be 0. So I got the values in the second pillar. Then what I will do, I will again back calculate. So 2.533 into 0.6010 plus 0 into 1 minus 0.6010. So if I calculate, I will get this value 1.492, which is the value of option today. right? Now the beauty of two things. One is that what is the drawback? Drawback is that the assumptions are very oversimplified. In practice, it doesn't happen this way. So this value may not be, maybe very far away estimation of the actual value of the option. This is the weakness. But what is the strength? The strength is that we can see here that at every node we are getting a value of the option. So after 3 months, I know that whether my option is in the money or it has become useless. After 6 months, I I can see that if it is still useful or is becoming useless. If I wish, I can extend it further for another 3 months. I can see further that which whether it remained useful or useless. Then another 3 months, 3 months, I can continue it. And in every point, what is the biggest drawback criticism of black and scholes, that it is a black box, that we can't see that what is happening inside. Something is cooking inside and throwing a result, but what is cooking inside, that is not very clear. But here, for decision making purposes, this option can be very useful, because at every point I can see that how the option price is moving, whether it is going up or coming down. Should I exercise, or should I wait for some more time? So these kind of decisions I can take in a better manner. So binomial is not a very sophisticated method for valuation, but of course it is a very useful tool for decision making.
Sir, when it comes these two model, black schools and binomial,
When? Pardon, sir?
when it comes, मतलब who implemented and when it come, date year.
Mostly in the stock market, the black and scholes is being used because they are continuously compounded. Even NSE also, when they for the
My question
market.
is, my
Yeah,
question is that when it you use मतलब when it was developed,
when it was
the time
developed,
when it was developed,
the time when it was developed. Hello.
in
Oh,
which
achha,
year?
achha. This black and school is around 72, 73, around 50 years back. Binomial, let me check. Binomial option valuation. Let me check. I think it is
Yes,
older.
79.
Oh, 79. Investopedia is saying that it is in 79. And black and school, almost both of them are around 50 years old. It is around 72, 73. Somewhere I read.
73.
Huh? 73. 73.
Yeah.
73. 73.
Yes.
Can you please elaborate on the
Sir,
probability calculation? Uh, how exactly the probability up and down probability is calculated?
That is the assumption.
Okay, so it's an arbitrary thing.
That is that gives a certain amount of 73. So yeah, that is the weakness.
Okay.
That is the weakness of this model. But this kind of simple questions may come, but if they give, they will give all the Suppose value of E and all these things they will give exponential values.
No, but this probability of up movement, down movement also
They will provide.
questions might come.
They will provide. Yes. So this is another problem. This is another problem where it is for put option. It is for put. It is for put. Here it is the same similar kind of argument. The only thing is that we can see here when the value of asset is falling, they are becoming in the money. When the value of asset is moving up, they are becoming out of the money. But other processes are same. It is actually the same problem. One is call, another one is put. In case of call, we can see here. Here we can see here. This has a value, but these are expiring useless. But here, in case of put, all the other parameters are same. These two are this one is useless, but these two are useful now. So then it is same. So 0 into 0.6010 plus 2.3 into 1 minus 60. So it is 0.9. And then 2.3 into 0.6010 plus 7.7 into 1 minus 0.6010. So it is 4.366. So now here, so we got this. So first we are going from left to right and then right to left, backward. So 0.9 into 0.6010 plus 4.366 into 1 minus 0.6010. So if I calculate this, 2.238, this is the value of the option. So at any point of time, if I find that the option is useless, right? So we can close, we can close that and come out of that option. So that is the thing. So this is the beauty of it. Okay. So this was the binomial. So that's how they did it. Now, yeah.
There is a question in the exam. We will have to calculate the probability using that formula first.
Not clearly audible. Can you speak little loudly? Hello.
In the examination, will we have to calculate the probability using that formula?
Possibly, but most of the time they provide this ready-made because the time is less, and they basically check the concept.
Okay.
So they may give you the value of P, and then they ask to calculate the value of the option.
Okay, fine.
So that is possible. Now. There is another, this is not actually a model, but a method of calculation, which is called the Monte Carlo simulation. Monte Carlo simulation. This is not a model like binomial, and it's not a model, but it is a method of calculation where the model is been iterated multiple times and then a mean has been taken. So usually it is done using the Excel. So this is a template for this. So this is the price of option. This is the price of underlying. This is the price of underlying, and this is the strike given. And this is days to expiry, fraction of a year, risk-free rate, and historical volatility. Now, it has been iterated. It has been iterated here. How many times? The stock price, this is actually nothing but randomized value of the stock price using Black and Scholes. This formula is actually Black and Scholes formula, right? And it is randomized using rand function, and then the normalized value of the random function is being taken. Now, how many times it has been iterated? Let's check out. It is iterated for 5,000 times. For 5,000 times it is iterated. That means what they are trying to do, they have a value here. They have a price here, right? And they want to know that if for 5,000 times I simulate it with other variables, what could be the possible price of the stock, right? And it is factored with a random number. Now, the strike is 225. If in case of call, if the stock price is 265 and if the strike is 225, then it is the call is in the money. We can see from this option chain that if the strike is lower than the spot, these are all in the money. So same here. So the strike is lower than spot, so the call is in the money. So in the money, the difference between the spot and strike, so 265.53 minus 225, so it is 40.53. And where it is less, the value is 0 for a call. Like for example, here it is 223.84 and here it is 225. So the strike is higher than the spot. So the call buyer will not allow to exercise. So it will expire worthless. So it is 0. It is 0. So this is call expiry value. This is call expiry value. What is the put expiry value? Put expiry value is this. So where it is the strike is higher than the spot, then it is beneficial for the put buyer, because put buyer has entered into to sell the asset as 225. In the market, it is getting sold at 223. So the put buyer will exercise. And what is the value? The difference between the two, 225 minus 223.84. So it is 1.16. It is 1.16. Fine. Okay. So we got 5,000 out of 5,000. We got the iterations where there is a call value, and we also got iterations where is the put value. And then what we did, we took an average first and then calculated the present value. So e to the power b6 is r and b5 is t. So e to the power minus rt into average of this call expiry value. This is the same formula which we used earlier. These are the possible call expiry values, and I am taking the present value of that to calculate. This is going to happen on the expiry date. This iteration I am doing for the expiry date. Fine. Today's value is 274, and I am trying to understand by iteration, by simulation, that what could be the possible stock price on the date of expiry, which is 32 days away. Now, based on this, I got some days where the call is in the money and some days where put is in the money. That is 32 days hence from today. So I calculate the average of this H column. This is 32 days away. So I am calculating the present value. So present value is e to the power minus RT. We did it earlier. E to the power minus RT. This one, continuous discounting, this formula. Right. So we applied this formula here and got the value of this, the call value. Similarly, for the put also we did the same thing, right? So if let's check out. So our price in our example, the price was Nifty is 11614. 614, no? No, sorry, 464. Sorry. 11464. And strike we have taken 11300. Days to expiry is 4. So fraction of year is this by 252. Risk-free rate, if I take say 6%, historical volatility, if it is not 17, let's see. What's the implied volatility? 11,300 is 17.6. So if I take 17.6 for example, 17. It is showing 1191. It's pretty high. One 1464 square 4. It is 213. It is showing 213, and my market price is 200.1, not very far away, giving a realistic result, the Monte Carlo. So, few questions on Black and Scholes is given here. Like this question, and answers and explanations are also given here. So it may be gone through. Some
You will share
like
with us.
this 17, question number 17. When the non-dividend paying stock price is $20, the strike price is 20, the same, the risk-free rate is 6%, the volatility is 20%, and time to maturity is 3 months. Which of the following is the price of a European call option on the stock? So, so this is the formula. In the options, you can see the entire computation they have not asked, because this normal function calculation, one needs Excel or a scientific calculator. So just the expression. So this is the formula, and in formula S naught and K is 20, R is 0.06, sigma is 0.2, time to expiry is 20.25. So if I put this, it is 19.7. So the expression is this. So it is, answer is B. B is 20 into n into 0.2 minus 19.7 and 0.01. So this is the, so like this, the entire calculation they will not ask, but simple calculations which can be done, that they may ask. Okay, so and also one in the study material, few questions are given. The answers of these questions I have given here. This also the team will share with you. You can see this type of questions. In the study material, there is a chapter on option valuation, under which few MCQs are given. These are the answers to those MCQs. Okay, we are almost at the completed with all the topics which need to be covered. Do you have any questions?
So in that last question where we had to compute 19.7 using that formula,
Yes.
again there was E, the calculation of E raised to the power. So this is also what we will have to calculate there, right? E raised to the power of minus
Yes.
0.06 into 0.25.
Yes. See, in the exam, in the exam, no such question will come, which is calculation of which is not possible without the help of scientific calculator, because I think scientific calculator is not allowed there. So scientific calculator or Excel, that is not a problem. That's not an issue. The most of the questions will come on the basis of concepts. That's all.
Okay.
For how much marks this topic gonna come?
I don't know. Maybe I think it is 7 to 10 marks. I believe 7 to 10 marks they ask.
Okay.
Sir, would you explain this call and put options in theoretical?
Call and put option. Okay. So I'm repeating it again. Call option is actually the right to buy, and put option is the right to sell. So when I am buying a call option, actually what I am saying, say for example, suppose I am buying a Nifty call, one lot of Nifty call. Now one lot of Nifty call, it consists of 75 contracts, right? So I am buying what? I am buying right to buy. Suppose my contract is I am buying a lot of call Nifty call option of strike of 11,300 and expiry on 17 September 2020. Suppose that is the specification, right? So it means what? It means when I am buying, someone is obviously selling me. If there is no seller, then there will be no trade, right? Like many out of the money options, if I place a order, that may not get executed at all, right? Because there is no seller. Now, this, when I am entering into the contract, in plain words, if I say, I am entering into a contract to buy Nifty, the portfolio, at the rate of 11,300 per contract, and it is an European option. So on 17th September 2020. So on 17th September 2020, I am committing myself to buy a lot of Nifty contract from the seller. And how much price I am going to pay for that? 11,300. But on 17th September, if I find, I am the buyer, right? So if I find that the spot price is 11,100, then will I go on buying it at 11,300? अगर उस दिन हम देखेंगे कि स्पॉट में 11,100 में निफ्टी सेल हो रहा है, तो 11,300 में क्या मैं खरीदूंगा?
Certainly no.
Certainly not. So I will allow this option to expire. लेकिन उस दिन मैं अगर देखूंगा कि स्पॉट में निफ्टी का प्राइस है 11,500, देन विल आई बाय एक्सरसाइज दिस ऑप्शन?
Okay.
जरूर
It means
एक्सरसाइज करूंगा, क्योंकि मेरा कॉन्ट्रैक्ट क्या है 11,300 में खरीदने का, और उस दिन 17 को वो बिक रहा है 11,500 में, तो मैं इसको जरूर चाहूंगा कि 11,300 में मैं खरीदूं.
it means I am buying an option
हाँ,
to buy certain which at a certain fixed rate,
हाँ,
a certain rate, which you call the strike
yes,
rate.
हाँ,
Okay. So
yes,
if it does not materialize or if it does not become beneficial to me, I will have the option. It is not that I have made commitment, I have to execute it. There is no
yes.
obligation for
As
execution.
as a buyer, you have the option to not to exercise the contract.
Okay. So that's why when the price is going
Huh.
lower, 10% lower, our the loss is it cannot become zero because I am not exercising the option. So the loss question of loss will not arise at all.
No, because
That's why you have,
it will become worthless.
yeah. Certainly, as a man of jurisprudence, I will not certainly execute the option.
हाँ. Now,
The question is
yes.
that if you are putting the 11,300 and in market so anybody who wants sell it will also give the 11,300 in 17 September 2020. If you are putting option, you want a call option.
Yes.
You are putting call option. You are saying in 17 September I will buy a security in 11,300.
Yes.
So somebody will also who are selling 11,100, he will offer directly to that person. He'll just buy 11,000.
No, the point is that the seller cannot go out of the contract. If the buyer exercises, the seller has no right. Buyer has the right because buyer is paying the premium, right? And seller has no right. Now you see. Now the point is that if on the expiry date, right, the buyer does not exercise, then the seller, what he will do, seller को तो जो प्रीमियम मिला था पहले का, वो प्रीमियम वो रख लेगा. इट इज जस्ट लाइक एन इंश्योरेंस. इंश्योरेंस में क्या होता है कि जब हम इंश्योरेंस लेते हैं तब हमारे पास क्या है, वी आर द बायर्स और इंश्योरेंस कंपनी इज द सेलर. नाउ एज अ बायर आई पे द प्रीमियम. Now, in case of life insurance, suppose if I survive till the maturity, then what will happen? The risk premium the insurer will keep, the LIC will keep, and rest of the amount वो मुझे लौटा देगा. And if I claim, if something happens within the before the maturity date, then the insurance company will pay the nominee the entire sum assured. So here actually the insurance contract is also very similar to an option contract. Now you see, now the point is that out of these buyers and sellers, who is facing more risk? The point is that I want to show you one thing. Because we have some time, so we can discuss. Like for example, say I am taking a call, right? So long call, payoff. So suppose this is a long call payoff diagram, this one. Okay. So this is the strike. So when the stock price will increase, my profitability will also increase. But if it comes down, my contract is to buy the share at 40. So if the spot is 30, I will not do anything. I will allow the option to expire. Then what will be my loss? My loss will be this, the premium. Here it is shown as 200. So that is the maximum loss I can make. This loss, my loss, this is a zero-sum game. So whatever is my loss as a buyer, it is a profit for the seller. So if I look at a say short call payoff diagram, we can see here this is exactly the mirror image of this figure and this figure. These two figures are exactly mirror image. So in market, what happens that in insurance we buy the insurance, we are long on risk, and the LIC sells us the insurance. But who makes more profit? Obviously, LIC makes more profit. So here also the seller theoretically, if I look, I can see that if it really goes as per expectation of the buyer, the possibility of loss is unlimited, right? But possibility of gain is limited because the maximum amount he can gain is the premium, nothing more than that, because his loss is only the premium. So seller's profit is only the premium. Theoretically, the call buyer can make unlimited profit. So call seller can make theoretically possibility of unlimited loss. But in practice, what happens that this call buyers are actually retail people like us, and these call sellers are actually the institutions. So most of the time, actually, the market moves in a range, and because of theta, because of this theta, this one, the option value continuously decays. We are looking at this thetas minus 7.91. If you observe this theta after 2 days on Monday, you will find that this option value is already came down because of this theta, because of this time decay. 2 दिन तो ऐसे ही चला जाएगा, सैटरडे और संडे। तो ये जो LTP है 99, ये अगर मार्केट अगर इसी लेवल में खुला मंडे को, तो ये फिर वहाँ इसका वैल्यू और गिर जाएगा बिकॉज ऑफ दिस थीटा. So the
that's means the call option is that it's a right to purchase, and it is this is based it on the purchaser, he will exercise his right or not.
Can you repeat the question? The voice is breaking.
My question is that the call option is that it is depend on the purchaser, he will exercise his right or not on that specified date.
For both call and put, it depends on the buyer whether he will exercise or not. If the right to exercise is always lying with the buyer. The seller doesn't have right. If the buyer exercises the right, the seller has to obligate. Okay. Okay, there are two queries. Expiry date we explained, strike price we explained, current market price, volatility, dividend, rate of interest. Okay, can you please put the price in example that we have done? Okay. Now, the dividend has an impact on the option price. Dividend has the impact because in the option price, usually when the dividend is been declared, usually the price of stock comes down. So the impact of dividend always taken into consideration while valuing the option price. Okay, there is another question. Put option, explain how it exercises. Okay, so the call is right to buy, put is actually right to sell. So we can see the long, say if I look at long put payoff diagram. Long put payoff diagram. So if I look at this diagram, for example, this is long put, right? So long put, we can see put is right to sell. So here the strike is 40. Strike is 40. Suppose I am the put buyer. So if I am the put buyer, then if it goes up to 50, will I exercise? I will not exercise. Why? Because my contract says that I have to sell it at 40. But in the spot, it is getting sold at 50. So why should I sell at 40 when I can get 50 out of it? So I will not exercise and I will allow it to expire. But if it comes down to 30 and my, then what is happening? So my right to sell is at 40. But in the spot, it is getting sold at 30. So obviously I will exercise. स्पॉट में वो 30 में बिक रहा है अभी, लेकिन मेरे पास राइट है 40 में बेचने का, तो ऑब्वियसली मैं 40 में बेचूंगा, राइट? एंड वी कैन सी that as the market falls, theoretically there is a possibility of unlimited loss. But if I allow it to expire, the maximum loss can be my premium. The maximum loss can be my premium. Okay, and this is a bearish strategy. Why? Because I am earning profit when the price is falling. So I am into profit when the price is falling. Therefore, long put strategy, this is a bearish strategy. Okay. Now, if I take short put payoff diagram, say if I change it to short put payoff diagram, then we can say it is just the mirror image of this earlier graph. This graph and this graph, they are just mirror images. Now we have to think like this. Suppose I am a put seller. If I am a put seller and if the price moves up, will the buyer exercise? Buyer will not exercise. If the price moves up, then buyer will not exercise. When the buyer will not exercise, the premium which he paid earlier, that I will keep with myself as a seller. So my maximum profit is the premium which I received while selling the put. But if the price falls, if the price comes down, then the buyer will exercise. If the buyer exercises, then I need to obligate. I have no other way. I have to obligate. So the possibility of loss is maximum in this case. So we can see here that short put is actually a bullish strategy. So a put seller makes profit when he makes profit when
What price goes up?
the stock price increases. When the stock price increases. And he makes a loss when stock price falls.
Actually, put and option is not like a sale and purchase. It is only exercising an option.
No,
Making money.
they sell and purchase. Initially, they trade. Like for example, here in option chain, I can buy this option 11,300. One person, I can sell this option. This I can do. But the point is whether I will make money or not, that will depend upon by expiry date, because if I purchase ITC share, I can keep it, and ITC price sometime will go up, sometime will come down like that. But in option, what happens? There is an expiry date. Now, whether I will make money from my position or not, that will depend on that whether my option is in the money or out of the money on the date of expiry.
Okay.
Okay, and also if the
I,
liquidity is high,
I,
yeah, I can close the position by taking a you know opposite. Uh, yeah. If I am a call initially, I have bought a call. Then if I want to close it, I can sell a call and close out my position. Okay, long and short call. This we explained. How buyer exercises that. Okay. Now for European options, right? On expiry, it will get automatically exercised. So till expiry, suppose if this option I hold till 17 September, at 17 September market will get closed at 3:25 p.m. If I buy and hold this till 17 September 3:25 p.m., then ultimately exchange will settle it, right? Exchange will settle it. If it is in the money, then the seller will pay the money, because these are all cash settled. In case of commodity, Nifty is cash settled, but if it is stock or Reliance stock or commodity, suppose if it is wheat and all these things, gold and all, then the seller will make the delivery. The delivery instructions are sent by the exchange to the buyer and seller. There the certifiers are there. They certify the quality, they certify the value, and then the buyer takes the delivery and seller provides the delivery. So once the contract is closed,
sir,
yeah,
the American option or European option, which is prevail in Indian
European,
in market, Indian markets,
European, because
all
in
question will be asked
uh,
from the European, or it may be asked from the American also in exam.
no, European. Because European is popular. The reason is in American, what happens, the buyer can exercise any point of time, even before the expiry date. So that creates a lot of volatility in the market. If I am the seller and in the morning, if I don't know that whether the buyer will come up with the demand or not, then it becomes very uncertain for me. But if I know that he will come up only on 17th, then I can prepare myself. So European, they are all European. Okay, I would suggest try observing option price action. Yeah, practically. It is absolutely practical. Who will be the counterparty for a short put buyer? Okay, you see, the short put means he is a seller, right? One cannot be short put buyer. Either he can be put buyer or put seller, or we can say is a short position in put and long position in put. So if he is taking a short position in put, that means if he is a put seller, then there must be a put buyer. So put buyer is the counterpart.
Mr. Banerjee, what is the difference between the short and the long?
Short is it is a market terminology. Short is sell and long is buy. So a call, when someone is buying a call, so we say he has taken a long position in call. And when someone is selling a call, we are saying in market parlance, we are saying that he has taken a short position in call. Same with put.
Okay, so put is also sell and call is buy.
No, for call there are two parties: call buyer, call seller. For
Okay,
put there are two parties: put buyer, put seller.
buy put. On the other, and then the
So
long and short.
long and short is call buyer is long, call seller is short. Long call, short call. Long put, short
Okay,
put.
okay. It has no relation with the period of holding the shares or the that is there is no
No,
connection
the
with that.
maximum period of holding is up to date of expiry for that contract.
Yeah, yeah. But I thought that this might be related to that kind of long and short as the nomenclature goes. So might be he's holding for a long period or short period. Therefore, is no connection with that one. No, no.
No, it is not in that sense.
Okay, I thought the long and short.
Yes. Yes. Okay. So I think more or less we covered. So I'm giving you my email ID. In case of
Okay,
any doubt, please
yeah.
mail
We shall
me.
remain in touch. Yeah.
This is my email ID, arindam20011 at gmail.com. So in case of any doubt or anything, thing required. Okay, difference between call and put. Okay, so difference between call and put we discuss. Difference between call is a right to buy and put is right to sell. Let me put it like this. So let me put it like this. So there are four parties in the market, right? So call buyer. Also, I am saying long call, same thing. Call seller. I am saying, sorry, I am saying short call, put buyer. I am saying long put and put seller. I am saying put. So call buyer or long call, what he is doing, buying a right to buy at a strike buyer this is what he is doing, right?
Yeah.
uh, Call seller is selling a right to buy, fine. Put buyer is buying a right to sell, and a put seller is selling a now is the difference clear?
Yeah.
They are actually exchanging the right. This is important.
Excuse me, sir.
Yes. Yes, please tell me.
Yeah, there is a question like with increase in time to expiration, the value of call option will increase or decrease?
Value of call option will increase.
Will increase, right?
Which one?
And this,
Just a moment. Tell me just what is the question? Can you repeat?
yeah, it's with the increase in time to expiration, the value of call option will increase.
Increase in time to it will increase, yes,
Okay.
because
So can you explain why will it
because of
increase?
theta, because of this Greek theta. So see this theta, this one, right? So theta is always, so the more we come nearer to the times of expiry, the value of option decreases
Okay.
because of time value. So if your time to expiry is more, then your option value should be higher. Like for example, just let's check it. Say 11,300 call, the premium is 200 for 17th September. Everything is same. The underlying is same, right? 24th September expiry, 11,300. The premium is 264. Longer the time to expiration, the higher is the value of the call.
And for put, it will totally be opposite, right?
No, for put also we can check. Let's see. For put here it is how much? 95. Okay. So let's go to 17. It is 41. Because we are talking about only time to expiry. The other things we are assuming it is constant.
Constant, yes, yes.
So the higher is the time to expiry, the far away it is from the time to expiry, the higher will be the time value.
Okay. There's one more question, sir. With increase in variance of underlying asset, the
Yes.
value of call option will. So, what is this variance they are talking about?
Variance is this standard deviation square,
Okay.
volatility. So if
Volatility. Volatility.
volatility. So if I look at this black and Scholes, you can see the volatility is one of the factors, and also volatility is the only variable parameter where the power is 2. You can see for S naught it is 1, power is 1. For K the power is 1. For R the power is 1. For T the power is 1. It is only the volatility where the power is 2. That means volatility has a very huge impact on the value of the option. And it is on the numerator. So that means if the volatility increases, the value of call will increase.
Okay. There's one more, sir. With increase in dividend paid, the value of call option will uh, decrease. So,
Huh,
how
because
is it related to this particular
because when the
topic?
dividend is paid, so this S naught will decrease. If I look at this formula, this S naught, this will decrease,
Okay.
right? So it will have an impact on the call, and S naught is on numerator here.
Okay. Okay. Thank you, sir.
So these type of questions now, just I would not suggest to memorize, but if these relationships between these five variables and the value of option for both call and put, most of the questions you will find that they are dependent on that. Suppose if rate of interest changes, then how it will impact the value of option. This also can be another question. Okay. It's like, okay, time value of money. Okay. Okay. So, uh, any other query? Okay.
No, sir.
Yeah. So the team will share all the documents. They will share this one, this PDF. They will also share this two Excel sheets and this two these two Word files. I think this is sufficient for the exam, but if you face any problem, then my email ID is there, right? I will immediately reply. Okay, there is another question: when to choose Black and Scholes and binomial? Binomial is mostly chosen at the time of decision making. Like for example, real options, right? In real options, where you need to take decisions. Okay, so there we go for binomial, and Black and Scholes usually we go with pricing of continuously priced options. For example, the options which are based on, say, unlisted stocks. So we here, for example, for listed stocks, I can get option values from here. Fine. So I can for Bank Nifty, for example, I can get like this. So other traded stocks, I can get the market value. But for unlisted stock options, I don't have the market value of the option. Then I need to calculate. So I can use this model for calculating the value of the option. But if I have to take a decision, for example, say in real option, suppose, say a company wants to launch a cold drink, right? A flavored cold drink, right? For example, for which there is ready market is not there. Okay. So suppose a company wants to launch a fruit drink on the basis of which is based on jackfruits, right? The mango drinks are available there, lychee drinks are available there, but jackfruit drinks are not available there. So he is not certain. So what he can do is, suppose they conducted one market survey, right, and also calculated the NPV and IRR. Fine. Now, as the market is not ready, suppose they got a negative NPV. Now, as per the classical capital budgeting rules, what we know that if the NPV is negative, then we should reject that proposal. Okay. But the higher management thinks that though the market is not ready for this and the NPV is negative, but within a year of time, if I give 1 year time, because people are getting health conscious, they want to do more experiment, right? So because of these reasons, and their choices are changing, their so this project may become feasible. They are thinking like that, but at that point of time, the NPV is negative, right? So the company, the higher management said that, okay, let's keep it alive. We will not pursue it right now, but we want to see for next 1 or 2 years that whether this proposal is executable or not, profitable or not. This is actually what? This is actually an option. The company is opening one option, right? So after 6 months, they can evaluate it. After 3 months, they can evaluate. They can see that whether the option is still in the money or out of the money, like this binomial tree, right? Then another 6 months, he can again evaluate, 9 months, 12 months. So after 12 months, if they feel that, okay, now it is in the money, I can go for this. So in such a decision making, here the value of absolute value of the option may not be that important, but the point is that for decision making purposes, this can be very, very useful. So in such cases, the binomial model is very useful, and it is used extensively. In stock market, mostly Black and Scholes is being used, because Black and Scholes, first is that they used for stock market is continuously priced, and BSM also gave lot of importance to the volatility, and stock market is very volatile, so it is used there. For other employee stock option, etc., also both of them are in use, both binomial as well as Black and Scholes. We don't have scope here, but the point is that in binomial, one thing I want to mention, that in binomial we consider 3 months. No, the time lags we consider 3 month like that, right? So if you reduce this period from 3 months to 2 month, 1 month, 15 days, 7 days, and then per hour, per minute, if you reduce it, then we can we can see that the binomial model actually converts into a Black-Scholes model. Okay, any other questions?
I think once we run through your presentation, there may be a lot of questions come up, which may
Yeah.
we may get
If,
further clarity.
in case of any questions, if you face any problem, please send me a mail. I will reply back to that.
Oh, thank you so much.
Okay, so should we call it a day?
Yeah. Thank you, sir.
Yes, sir. Thank you so much.
Thank you very much. Thanks.
Thank you, sir.
Thank you so much, sir.
Thank you very much.
Thank you, sir.
Thanks.
Thank you so much.
Thank